This is On the Money.
We've been following the money behind Chrysler tonight, the perfect example of a struggling stock that's a great buyout. If you're tuning in late, Kirk Kerkorian's Trecinda investment arm offering to buy Chrysler for $4.5 billion. Our insiders tonight on why private equity sees cash where shareholders don't. David Dole is president and CEO of Cantley Trust Company, and Steve Rosenbush is senior writer at businessweek.com. Steve, why does private equity see value in stocks that have failed stockholders?
Well, Melissa, the public markets are based on growth. Companies are rewarded for growing, preferably at a steady quarterly pace. Private equity operates on a different system. They have a time frame, as pointed out in the last segment, of 3-4 years. But during that 3 or 4 year period, no one's expecting the acquired company to post quarterly profits.
David, how can public investors play bad stocks that make good buyouts, do you think?
Well, I think Steve's exactly right. There's nothing new here. It's about value, and when stocks miss earnings, when they fail strategically or managerially, they represent a value play. The only thing new is that private equity is just a wash in cash.
But how do you know the difference between a company that's a horrible stock and a company that's a beaten down stock that's a good takeover target?
Well, therein lies the devil in the details. It could be a strategic issue, or it could be just poor managerial execution. And as you've been talking about, sometimes you see lowball offers like a Trecinda Corp offer on Chrysler.
Steve, you've uncovered a lucrative way to make money on this private equity paradox, the credit default swap market. Explain that to us.
Well, Goldman issued a really interesting report a month or so ago that takes a look at a variety of ways in which investors, different kinds of investors, can make money on LBOs, whether they're part of a private equity firm or not. One option is to buy the stock. Another option is to buy the option. And another, and possibly a more arcane route, is to buy insurance on the credit or the debt of a company that an investor thinks is likely to be acquired in an LBO.
So, Steve, do you have examples of companies right now you would do this with?
Well, Goldman put together a list of dozens of companies that could make good LBO targets, and it studied their rate of return, their internal rate of return, which takes into account the future cash flow or the future earnings of a company. A lot of these companies have returns of 30, 40, 50, 60%, according to their analysis. And a good many of these companies, publicly held companies, which also...
Do you have any names, though? We want to help our investors make some money out there.
I think that Super Value, the grocery chain, has credit swaps, which can be purchased. And that's an example of the kind of company that could possibly be used in that sort of strategy.
Any others?
There's I think a good case to be made for Unisys, the information services company, very large company, and another company that also is likely or attractive to LBO buyers.
David, what do you think? Do you have any plays on this?
Absolutely. Take a look at a company like Pier 1, for instance. Here's a beaten-down retailer that has seen their market niche really attacked by the likes of Walmart and Target. Tax loss selling at year-end, and it's stabilized. It would certainly seem to us that investors are just biding their time looking for a financial buyer.
David, any other examples for us?
Yeah, a couple quick ones. Altel, here's a company that really hasn't been beaten down, but there's no secret that it's out looking for a strategic buyer. That hasn't yet materialized, and they've got some wonderful assets and a very strong balance sheet and cash flow coming. Those are two ideal components that private equity looks for.
All right, very interesting tips there. Thanks a lot to both of you for joining us.